as long as the person is materially involved with
Exactly.
their property, it is used.
Documented.
And
Please
it's
document.
funny. They call that, people call that the short-term rental loophole. I hate that term because it's not a loophole.
It's
It's
not a
written into the
loophole.
taxes. It's
It's a
intended to be
business.
that way. It
Yeah.
is a business. In essence, it is a commercial property, so it's treated like a commercial property.
Mm-hmm.
As long as you are materially involved in that property.
Not sure if you've heard, folks, but there is a bill going through Congress right now that could possibly bring back bonus depreciation to the tune of 100%. Currently, as it sits, it has been ratcheted down to 60%, but we will get into the history. We will talk about what it is. We'll talk about who leverages it and all of that good stuff. David, welcome back. How you doing, buddy?
Thank you. I am well. It's good to talk to you.
Yes, folks, if you don't actually remind people what you do, who you work for. I've used your services on some of my purchases, but remind folks the organization you work for.
I have my own company, which is Cash Flow Strategies. Part of what we do is cost segregation with a company called CSSI Cost Segregation Services. Actually invented the modern method of doing cost segregation. We are the largest provider of engineering-based cost segregation in the US, and not going away.
There you go. So let's actually let's take a step back and remind people what cost segregation is. Because again, if you are in real estate, if you're a landlord and you're not thinking about it, there's something called straight line, but there's also something that the big boys use called cost segregation that basically takes the building, divides it up into pieces because stuff depreciates at different rates. But why don't you tell us from your perspective, what is cost segregation first?
Cost segregation is actually the accurate way of depreciating property. Typically, when you buy rental real estate, it's depreciated over 27 and a half years. Commercial, industrial, or short-term rentals are depreciated over 39 years. And the easy way to do it is just to make the whole building one piece and take it straight line. But the tax code says that you don't have to do it that way. A more accurate way, if you do it right, is a cost segregation study that will basically, on paper, break the property down into all of its component pieces and parts, a lot of which, in fact, everything non-structural can be depreciated at either 5, 7, or 15 years. So shortening the period of time for depreciation actually increases the deduction on your taxes, which is a great thing. As of 2017, because of the Tax Cuts and Jobs Act, that's when we got bonus depreciation. Bonus depreciation was basically put into effect to encourage people to invest in real estate because it's great for the economy. And so what that said was, during the Tax Cuts and Jobs Act period, 100% of all that short life property can be depreciated the first year, which makes for huge tax deductions. So instead of the 15-year property going 15 years, you take it all the first year. Instead of all the interior stuff that's non-structural, you take it the first year instead of 5 or 7 years. And so it made for some great tax deductions for people. Because of the way they had to pass the Tax Cuts and Jobs Act back in 2017, using budget resolution or
continuing resolution, CRs.
Basically, it had to sunset after 5 years. And so at the end of 22, it moved for 23 down to 80%. And then now in 24, any property placed in service in 24 is 60%. Next year will be 40, then 20, then 0 in 2026. But, so that's where cost segregation and bonus depreciation came from. It's actually been in the tax code since the 60s, but it was at a point where only the wealthiest businesses could afford to do it.
Yeah, I want to talk about cost segregation. Again, you have a playlist on my channel. This video will be put there. They can go back and watch some of our older videos. Cost segregation was something for a long time that only the really rich, the deep pockets could do. But again, even without bonus depreciation, cost segregation is valuable because, again, you could take the asset, in this case, real estate, and you could correctly depreciate different items. And I want to remind folks, you can see it in the playlist. You helped me with a particular purchase. I think it was in 21 or maybe even 20. I don't remember. But basically, I'll use round numbers. I bought a duplex for 200 grand. I paid for your service. And again, you guys aren't using some BS template online. We had to coordinate to get your engineers in my building, so they could take pictures and measure and, do all of that stuff. And essentially you took what would have been a straight line depreciation of, I don't know, call it, I don't know, 4,500 bucks. And it really jumped to like 35 grand or something like that.
Yeah,
And that all happened year one. So I was very thankful.
and that was on what we consider to be a small property.
Yes, it was
Um,
small.
In fact, I've now, I think, done 23 properties for your buddy Omar.
Yeah, he told me.
Omar's not paying any taxes for the next couple of years.
Yeah.
And
Yeah,
if
folks,
we continue to do them at about 6 a year, he may not pay taxes for a very long time. So
exactly. Yeah. Omar and I've talked about that a bunch off record. Omar, if you guys don't know who we're referring to, is our Tuesday guest, Omar from the high desert area. But yeah, this is something that, cost segregation is something that the rich have used. It is legal. It is part of the tax code. Bonus depreciation really was the cherry on top. It's like, okay, hey, pay for the cost seg, get year 5 items, 7 items, 15, and just go whack, push that all into year one. And that was part of the Jobs Act.
and what it did was it gave investors more capital to invest, and it worked. And what we could use right now is a little bit more investment to bring the economy back around.
Yeah, I mean, let's just play that out. So again, in my example, and again, I'll use rough numbers. I took about, I think it was 35 grand there. Let's call it 30 grand just to keep a round number. And that was a tax savings. But at my tax rate, that was like, I don't know, 15 grand of real cash.
Yep.
Right. Cause I get to keep some and tax some. So that 15,000 bucks just went right back into the next investment. And if you take that little 200K purchase and make it 2 million, or heaven forbid, 20 million, now we're talking, big money put back into the system. So there is talk that they are going to bring 100% back. I think it is in a proposed bill that looks likely. I believe it will also be retroactive. So talk about why that's important.
It's more than just a proposed bill. It was passed overwhelmingly by the House Ways and Means Committee and the Senate Finance Committee. It is at the full House right now. It's called the Tax Relief for American Families and Workers Act of 2024. And it involves a number of other things besides bonus depreciation. But on the business side of it, and for the residential real estate investor, it includes 100% bonus depreciation. It's retroactive to the beginning of 2023 when the bonus percentage started going down.
Oh, I want to be clear on that. So it's not only retroactive to January 1st, 24, it will go all the way back to 23.
Exactly.
Woo!
And,
okay.
If you haven't filed your 23 taxes, I've been telling people, hold
Wait.
off.
Time
hold
out.
off till like late February, because we're hoping that this bill will be signed into law by then. And it extends 100% bonus depreciation through the end of 2025.
Okay.
Then it'll revert back to 20% like it would have done for 26. But what that means is it's extending it to the end of 25, where there will be another big battle in Congress to extend it further. Because to me, it's just good for the country. It's good for the economy. It also involves some other business-friendly aspects too.
Yeah. What's the name of the act again? If somebody wanted to research it, is it called the Tax Relief Act, or what's it called again?
It's the Tax Relief for American Families and Workers of 2024.
Got it. I just wanted.
It was passed by the House Ways and Means Committee 20-4.
Oh wow.
It's bipartisan.
So it's past subcommittee. Now it's to the full.
It's before the full House. It is bipartisan.
Nice.
Because the things that the Republicans wanted included the business-friendly aspects. The things that the Democrats wanted included an extension of the child tax credit. And so everybody wants it.
Okay.
Of course, there's always squabbling going on saying it's not enough. It's not this. It's whatever. But chances are, I think it'll pass. And it's just a matter of how fast they get it passed so that we can include it on our 23 taxes. And if not,
Yeah.
you can always amend and take care of it.
Yeah, well, let's talk about the process because I've been through it, right? If we think this is something that might go through, and I would argue that cost segregation, even without bonus depreciation, is a good thing. In worst case, you get 60% of it today, or this year, I should say. But if we can go back to 2023, that's a lot of potential purchases. I think there's a lot of folks, myself included, looking at bigger buildings this year. I mean, think about this. I've been telling folks for 2 or 3 years now, I'm buying residential, I'm buying residential, I'm buying residential, because I expect commercial to blow up. And lo and behold, we are on the cusp of commercial blowing up. So play this out with me, right? I sell a single family home at record high prices. I take that 2 or 300 grand in equity. I roll that into a 20 unit building. I get that 20 unit building for, I don't know, 2 million bucks. But 5 years ago, it sold for 3 million. I'm just playing with numbers now.
Sure.
But that 2 million bucks, I roll in tax free because of a 1031. So no cash. Then I pull out a cost segregation study, which allows me to take, I don't know, 210 grand depreciation the first year, whack, right to the bottom line. I win both ways. The 1031 exchange, I don't pay the IRS. Then I take $210,000 against my income because I'm a real estate professional. Kind of win, win, win to me. That's what I see coming.
I have the best job in the world.
You get to save people money.
I just did a flight school. Guy called, he was referred by somebody else, and he had just built a flight school in the Las Vegas area. And we did the estimate for him. And I always tell people that we try to shoot about 10% low on the estimate, so that, because I like making phone calls saying, hey, we got you more.
Got you more. Yeah.
Well, the estimate showed him taking $1 million in depreciation, an extra $1 million in depreciation the first year. When the study finally was done, he got $2 million worth of extra depreciation. The guy was a very, very happy camper.
Yeah, and again, the great thing about your organization is you stand behind your audits because, again, they're physical engineers, all of that. So if somebody were to get an audit question, you and your company stand behind it.
We have done over 45,000 studies across the country, all 50 states. We have never actually triggered an audit, but if somebody's audited on something else and the study is called into question, we will defend it at no charge for as long as it takes. And we've never had a change with the IRS.
There you go. The other thing we should talk about is, let's talk about short-term rentals. A lot of people got into that game. A lot of people don't realize that short-term rentals are really categorized differently, right? If you're following one rental at a time, it's categorized as passive, but short-term businesses are active, and active income triggers all kinds of different accounting. Check with your CPA. But first and foremost, as you said in the intro, it changes depreciation because it's a business, right? 39 versus whatever it is, 27 and a half. But also it goes right against income, right against W-2 income.
As long as the person is materially involved with their property, it is
documented.
And it's funny. People call that the short-term rental loophole. I hate that term because it's not a loophole.
It's not a loophole.
Into the taxes. It's intended to be that way. It is a business. In essence, it is a commercial property, so it's treated like a commercial property. As long as you are materially involved in that property, which there's 7 rules. You have to match one of them. You have to say yes on one of them. But really, the 2 most important is you have to spend 500 hours on working on your properties in the year. You can aggregate your properties if you want to, or it has to be 100 hours, but more than any other individual.
Okay.
So if you're scheduling the cleaners and you're whatever, you're handling the repairs, or at least getting the person to do the repairs and whatever, you're materially involved. As long as you have it documented, just document everything.
Yeah, document. Yeah.
But then it can be used directly against your W-2 income. There's another thing that some people don't realize. In fact, this has been a banner for me because I've had arguments with CPAs and real estate attorneys on this. Let's say a doctor builds an office or buys an office to put his practice in. To protect himself, he puts it in an LLC.
Sure.
Okay. So typically, if you go straight by the understanding of cost segregation, the LLC would do the cost segregation study, and really all that they can use it against is the rent that the doctor pays the LLC. However, there is a thing in the tax code called grouping of entities. I don't know if we ever talked about this before, but
I don't think so.
if the ownership and the purpose is in common, so the doctor owns the practice, the doctor owns the LLC, and it's used for his office, he can actually combine those two entities for tax purposes and use all the depreciation on the building, even though it's in an LLC, against his practice income. Huge, huge. I've been working a lot lately with some doctors, because they're moving into bigger buildings, or they're adding onto their buildings, or they're doing whatever. By the way, cost segregation can also be used on tenant improvements. You don't even have to own the property. If you do a major build out in a rented space, we can cost segregate the work that you did for you, save you a ton of money. And typically none of that is structural. So a lot of that is able to be accelerated. The other thing is, if let's say you did a major build out in that duplex that we did, you're going to put a new kitchen in. We can do a cost segregation on the new kitchen, but not only do you get the accelerated depreciation from the stuff that you put in, we will calculate a write-off for you of everything that you tore out.
Yeah.
It's called partial asset disposition, including like the cost to haul away the old cabinets.
Exactly.
You can get money off, because otherwise, if you think about it, you'd be depreciating two kitchens.
Right. Exactly. Yep.
But unless you know what those items are from a cost segregation study, you'd never be able to do it.
Yeah. The other thing you got to remember, there's a lot of people looking to do ADUs. My good friend Thatch Nguyen is pushing that up in Seattle. I think it's a great idea for folks. Again, you can cost seg the build out of a brand new ADU.
Oh yeah. Yeah. And those are great because you don't have to worry about taking any property value out, because you've already handled the property, newly constructed. And we can go back. I mean, even if you built an ADU 3-4 years ago, we can still go back and do the cost segregation study. You don't have to amend any taxes. It's easy. I can go back 15 years for anything that has a cost basis, not including land of over $150,000. So it doesn't have to be a big property. A lot of people think, oh, gee, well, I can't do it because my property's not worth $1 million. Nah, it doesn't matter. I do those every single day.
Yeah, I think that's important.
There is a caution. And I've said this before, and I will say it again. Please, if you're going to do a cost segregation study, of course, I would prefer that you did it with me. But if you don't do it with me, make sure that you only consider an engineering-based cost segregation study. There is a big rise, including some people who are big on real estate in social media, who do what they call DIY cost segregations.
That sounds like a recipe for disaster.
You plug some numbers in and it spits a report out. Yeah. I heard from one of my clients that he had a friend who did 10 properties down in Florida, did DIY. He said he did them and he got hammered by the IRS. And he was concerned, with me about getting, and I said, we've never triggered an audit. Why would he be audited on that? And he said, I don't know, but he paid like $3,000. No, he paid like $300 to $500 per each one. I said, oh, I can tell you why. Yeah. Because it's a DIY cost segregation and there's nothing there that'll stand up. I mean, if you don't get audited, great. You
got lucky.
You got lucky. There are also those who will do it and they don't do the site visit, whatever.
I think I shared this, David, when we did our survey. The reason I picked your service and bring you on the channel is I've unfortunately been through a rather deep IRS audit. It wasn't fun. It was fair, right? If you make a bunch of money, you eventually get audited. it took over a year, and I was only going to be working with folks who document it, will stand behind it, and do all of that. So having that report in the engineering study and site visits, it's just not worth the risk. You don't want to do
I
a
even saw
freaking do it yourself. It's crazy.
I saw one that advertises that they do engineering based cost segregation, but they don't require a visit. What I
Ah!
found out when I dug a little bit deeper, and it's a name that I know you know,
Mm.
and a lot of other people know on social media, they only do an engineering based cost segregation if you get audited.
Oh, they do it after the fact. Oh, great. Oh,
So
no.
what that means is their study's not accurate, but if you get audited, we'll do an accurate one. I just can't, I would never,
No, I
it took
mean,
me 2 years to decide on a company to associate with to do
mm,
cost segregation. And my reputation, my name is far too important to me to work
mhm,
with anybody who doesn't do the very best study available. So there
no.
you go.
I like the process. I mean, again, how we did it, and it'll be similar for you, is you bought and closed on a building, you reach out to David, get an estimate, which takes 24, 48 hours. You like the estimate, then you pay half, as I recall, for
Right.
the survey. You coordinate with the tenant and or property manager. They get in there, I don't know, a couple weeks later, the report comes out. You get a report. David calls you. You go over it, and you pay the other half. And what I did is, at the end of the tax year, I brought the report to my accountant. It was in my stack of stuff, and he goes, "What is this?" Okay, I got it. Okay, great, thanks. Put in the number. There's some other form he had to include in my amendments, or whatever they're called, addendums, but it was easy, lickety split.
That form is only required if you have depreciated the property already straight line for a
Mm.
year or two or 5 or 10. And basically it's a change of accounting procedures for a change of accounting
Ah,
methods form that lets the IRS know you're moving from straight line to accelerated depreciation. And it is a major pain for most CPAs to fill out. And so we do it for them. We provide them a
exactly.
draft copy. They just have to sign it.
Yep, there you go. So again, I guess we need to watch the Tax and Relief Act. I'll just shorten it to that for 2024.
I will
Um,
be providing constant updates on my Instagram channel, which is just my first name dot my last name, which is Wiener, David
there.
Wiener on Instagram. And I will be doing updates. I've already given one update on it and I'll be
Nice.
constantly doing, I mean, it's not one rental at a time, of course, but
I'll forward it. I'll follow you, and I'll forward it to the
you
channel.
got a
Uh,
fancy studio and everything.
oh, I do. I do. It's a lot of fun. David, where if somebody wanted to reach out to you, let's give your phone number for text messages. If they wanted to review their situation, ask questions about this, see if their situation warrants it. How do we do that?
You can call me or text me at 770-367-8091.
Awesome, folks. Again, something we got to watch, the Tax and Relief Act. Regardless, cost segregation, as it currently sits, bonus depreciation will get you 60% of it year one. It might go back to 2023, which will be at 100% kind of retroactive. Pretty cool. David, thank you for coming back. Take care.
My pleasure. I love talking to you.